Which will come first? An unexpected twist or tomorrow morning? The Fed just released a high-stakes suspense thriller for the global markets. As soon as the decision dropped, the bond market went into a total frenzy. The anchor of global asset pricing, the 10-year Treasury yield, shot straight up past 4.43%, hitting a fresh one-month high. Under this kind of heavy macro pressure, gold naturally took a massive hit. It was ruthlessly slammed down to an intraday low, near $4,518. But as fate would have it, the unexpected happened anyway. In just a few hours, gold didn't just stop crashing, it bounced hard back to the $4,580 level. It literally clawed back nearly $70 from the lows. At the same time, two key signals suggesting this slide might be over are quietly surfacing. So, what kind of signals could actually flip the script for gold prices? G'day Gain Squad! Welcome to Goldie Gains. Every day, I bring you the sharpest, deepest financial insights to help you see through the market fog and stay 10 steps ahead of the crowd. Before we break down these two signals, we have to understand the macro earthquake Wall Street just felt. It started off boring, the Fed held rates steady. Everyone expected that. But the second the decision went live, everything changed. Out of the 12 core voters who hold the power over global capital, 4 actually voted against the move. 3 regional Fed presidents took a super hawkish stance, refusing to even hint at future easing in the official statement. In the history of capital markets, the last time we saw this much internal drama at the Fed was back in 1992 under Alan Greenspan. It's been 34 years since the people in charge of the global money faucet have had an internal feud this big. Even more intense was Jerome Powell's follow-up. Facing political heat, the man at the helm basically laid his cards on the table. He's not leaving when his term ends. Even if he has to step down to a regular board member, he's staying at the Fed to finish the job. He's basically telling Wall Street, don't expect me to fold and print money. He's keeping interest rates locked down tight. That exact statement became the fuse for the market explosion. The 2-year Treasury yield, which is super sensitive to policy, jumped 10 basis points in a single day, nearing the 4% danger zone. Big money tore up their rate cut bets overnight, and some even started pricing in a rate hike for 2027. With Treasury yields skyrocketing, gold, which doesn't pay interest, faced immediate selling pressure, causing the charts to take a dive. Honestly, you didn't even need the Fed meeting to see the exhaustion. The back and forth grinding over the last 2 weeks has already drained most investors. Why is there such a huge gap in how people see the same market? If we ignore the short-term panic and look at the charts through a magnifying glass, 2 core signals for gold are emerging. Today, we're peeling back the layers on these hidden truths. The first core signal is, the market refuses to drop despite extreme bad news. The legendary trader Jesse Livermore once said, "The market is never wrong, opinions often are." According to the textbooks, with the Fed's worst internal split in 34 years and yields soaring, gold should have crashed below $4,400. But look closely at the Thursday Asia session. When gold tapped $4,510, it didn't trigger a massive stop-loss chain. Instead, it hit a wall of buyers and surged back to $4,580. Why wouldn't gold stay down after such a massive macro blow? The simplest reason is that the buying power sitting underneath is incredibly strong. When the price dipped after the big news, we didn't see the death spiral shorts were hoping for. Instead, we saw massive resilience. Where is this support coming from? A huge report from the World Gold Council just revealed the big picture. In the first quarter of this year, global central banks went on a shopping spree, buying 244 tons of gold, the fastest pace in over a year. Plus, gold ETF inflows in China hit a record high. Now, we can't say for sure that central banks hit the buy button exactly at midnight. But the hard data proves a cold truth about the market. In an era of sanctions and a shaky dollar, central banks and institutions have made buying the dip a long-term rule. This creates a massive contrast. While average traders are looking at 4,510, terrified of being liquidated or too scared to move, the smart money is sticking to the plan, buying the dip right after the chaos. Because there is this sovereign-level buying floor, every macro-driven drop just becomes a Black Friday sale for the big players. With that foundation, the bears can throw all the ammo they want, but they can't break the floor. But long-term buying isn't the only thing happening. This leads us to the second key signal, cross-asset divergence and the repricing of real interest rates. While the Fed is holding the no rate cut button to fight inflation, the situation in the Middle East just got very volatile. To break the deadlock, Trump made some very tough comments about continued blockades until nuclear issues are solved. Iran fired back, warning of unprecedented military action if ships continue to be seized. This real-world geopolitical chess match broke the energy market. WTI crude oil jumped 8.66% in one day, smashing through the $108 mark. Brent crude also climbed to $113.80, nearing its highest levels since the conflict began. Oil is the lifeblood of industry. Oil over 100 means costs will spike everywhere. The inflation data for the next few months is absolutely going to see a violent rebound. This brings us to a crucial piece of trading common sense. Gold's long-term fate isn't decided by the nominal rate the Fed talks about, but by the real interest rate. What is a real interest rate? Do the math. If the Fed keeps the rate at 5%, but prices are rising at 8% because of oil, the money in your bank is actually losing 3% of its value every year. That is a negative real interest rate. Because the smart money has already done this math, we saw a cross-asset divergence last night that defies traditional logic. So, where exactly is the divergence? Usually, if the Fed is this hawkish and yields are soaring, US stocks and gold should both get wrecked. But if you look at what actually happened, the market was completely split. On one hand, WTI oil spiked nearly 9%, sounding the inflation alarm. On the other hand, despite a hawkish Fed, US stocks didn't panic sell. The Nasdaq even managed a small gain. Gold also recovered its losses almost immediately after a quick dip. The answer to this illogical behavior is hidden in the expectations of big money. The main trading theme for global capital has quietly shifted. The Fed is keeping nominal rates high, but oil at 100 means inflation is running faster. Big money has stopped listening to the Fed and started pricing in the power of returning inflation. This means real rates aren't going up. They are being squeezed by high oil prices. In a crisis, money flows into tech giants with cash flow and gold that protects against inflation. This explains why Goldman Sachs, despite warning about short-term volatility, is still sticking to their year-end target of $5,400. Gold's role as the ultimate hedge against currency devaluation has been massively reinforced by this energy crisis. Once you see the buying floor and the logic of shrinking real rates, we get a very valuable conclusion. Gold's one-way slide down to test the lows is likely coming to an end. That doesn't mean it's going to moon instantly. We are moving into a high volatility bottoming phase that will test your nerves. During this stage, swings of $100 or $200 will be normal. If you're using high leverage CFDs or futures to catch the falling knife, you're going to have a bad time. Even if you're right about the macro trend, one quick spike against you could wipe out your margin. So, how are the smart money playing this chop? They are using a strategy that seems too simple: dollar cost averaging into spot gold ETFs. It looks dumb or like a lazy way to invest, but in this market, it's actually the ultimate move. ETFs don't have leverage, so they are immune to being wiped out. In this bottoming phase, you set your grid, and if gold drops, the system just buys more cheap shares for you. When gold finally finishes the base and heads toward 5,400, those cheap shares turn into massive profits. It's not lazy, it's using iron discipline to remove fear and greed from the trade. Keep your core positions safe with a steady plan. Once you have that bulletproof vest, you can use CFD leverage to chase extra gains once the trend is confirmed. We call this spot for the floor, leverage for the ceiling. Finally, let's look at the gold 4-hour chart and use technical analysis to back up our macro theory. Remember yesterday we talked about a bullish shark pattern forming? Yesterday's dip to 4,510 didn't break the pattern. It actually created a classic fake breakout to hunt stop losses. A fake breakout is when the big boys intentionally push the price below a major support level, like 4,555, to trigger everyone's sell orders. When regular traders panic or get stopped out, the pros buy up those cheap shares and rip the price back up. Basically, they dig a hole to scare you off the bus, take your seat, and then drive away. Looking at the 4,510 low, it perfectly retested that 4,492 to 4,515 support zone we mentioned. It didn't break through, it found actual buyers and bounced. This confirms the support zone is real and completes the right side of our bullish shark pattern. Even better is the KDJ indicator at the bottom. While the price made a new low at 4,510, the KDJ indicator made a higher low, a clear, bullish divergence. This is proof that the selling momentum is dying. It's like a car revving its engine while the gas tank is empty. The market is always full of noise. The ones who walk away with profits are the gold getters who understand the macro cards and hold their discipline like a machine. After seeing this deep dive into macro and technicals, I want to hear from you. Do you think gold's pullback is officially over? Or is this just a dead cat bounce before another big drop? Drop your thoughts below. If you see the charts differently, let's chat and get those trading ideas flowing. Of course, a quick serious note. Everything we discussed at Goldie Gains, the analysis, the data, the logic, is just my personal observation of the market. This is absolutely not direct investment or financial advice. Trading is risky. Everyone has different capital and risk tolerance, so do your own thinking and take responsibility for your own trades. If this video helped you clear up the market confusion and see where the smart money is flowing today, please give us a like, subscribe, and hit that bell so you never miss a deep dive. Share this with a friend who's feeling lost in this market. Every bit of support is what keeps Goldie Gains going. This is Goldie Gains. Keep your positions tight and keep those gains golden. I'll see you at the next close. Cheers.